Hello, everybody, and welcome back to a special edition of the M3 Melody Market Update. My name is Melody Wright, and I come on this show to talk generally about macro and housing. And today I am very honored to have with me Joe and Jeff Snider. Joe, say your last name for me because I always get it wrong.
It's okay. Everybody does. Joe Batag.
Batag. Yeah, I have to repeat it over and over. So I have these guys with me today. We're just gonna have a general conversation. I know Joe. He reached out to me some time ago, just talking all things real estate. And so, and then Jeff, of course, you guys can see in every single show note I link to Eurodollar University because they are foundational for my thinking as to what really transpired last time. So very excited to have you guys. Welcome.
Oh, really looking forward to this, Melody. Thank you very much for the invitation.
Oh, cool.
Same here, Melody.
Yeah. Okay, so I was just thinking we do kind of a free flow, conversation. And for me, I have my MBS Live dashboard up right now watching the 10-year treasury and MBS pricing. And it's kind of wild out there. So Jeff, any thoughts on what we're seeing with all of this around, the war, et cetera?
Yeah, so it's one of those things. What are we going to talk about today, right?
Right.
I mean, we're really, where do you want to start? So if you want to start in the bond market, you see what the markets are having to contend with. It's that central bankers are running around talking about having to hike rates. And so the market is desperately trying to price the natural tension between what an oil shock actually is and what it will produce in the real economy, which is higher levels of unemployment. And central bankers who are stuck on their expectations theory, thinking that higher near-term consumer price rates are going to somehow translate into longer run inflation, not just expectation, but actual inflation itself. So the question for the bond market is, how long can central bankers get away with hiking rates before they're forced to turn around and realize that in reality, the risks of the economy are all on the downside? I think it was interesting that yesterday, we actually had a little bit of common sense coming out of the official sector when the Bank of Mexico actually decided we're going to restart our rate cuts. And let me say that again. Yes, they restarted the rate cuts because they saw the oil shock correctly as more likely to contribute downside to the economy than any upside in consumer prices. Again, consumer prices are going to be ugly in the short run as oil prices translate directly into CPIs. But outside the short run, have a weakened economic system that is already producing job losses in the United States, rising unemployment around the rest of the world. You add some energy price pressure onto employers, it doesn't get into an inflationary spiral, it gets into an unemployment spiral. So whatever happens in the short run, central bankers that do hike rates, chances are very likely they're going to end up turning around and going back down again relatively quickly. So the bond market is saying, well, how long will that take? What will it take for central bankers to get, thrown out of their current funk and get out of this rate hiking mode and get back into where they're likely to be responding to reality on the ground? And that's why you see uncertainty on the yield curve is probably the best way to put it. The upward bias in rates is really just about timing.
Yeah. No, I completely agree with you. And it's just kind of, it's crazy to watch because, we were told at the beginning of last year that, they wanted to get that 10-year down, that was all the focus. So watching the absolute opposite occur, again, as it did last April, is just kind of wild. And, we're watching in talking to mortgage clients, they're pretty much depressed at this point because they're, it's just, every time they think that they're going to get a break, they don't get a break. And it just goes right back. Like we went under 6% for I think a day.
A couple of weeks there, right?
And it was like, boom, it just shot right back up. And so, but we've had that rate cut hopium for years now in the market itself, in the mortgage market, and it just hasn't panned out.
Well, that's the front end of the curve is stuck. That's the problem. The Federal Reserve won't tariff inflation, or before that it was sticky inflation. They always have this inflation bogey that they're trying to tilt at the windmills at. Their quixotic quest for inflation theory and inflation pressures that don't exist. I mean, one thing that you can look at right now, we know what the bond market is doing because it has nothing to do with inflation. Just look at TIPS. Yeah. TIPS break-even rates have barely budged, certainly nothing like they did in 2022 under similar conditions. So the market is saying this is not inflationary. We're just trying to again price what we think central bankers will be doing, which is the problem the market has been confronting since 2023. So with a steepening yield curve, all of that pressure gets put on the 10-year. The short end has to go down a lot further before you get any real movement in the 10-year. And unfortunately, central bankers have been resisting for all the wrong reasons for as long as they possibly can.
Yeah.
Jeff, you've been talking about the parallels to 2008 from an historical standpoint. Can you maybe elaborate a little bit more on that?
Yeah, I don't want to get too much into the comparisons because it gives people the wrong impression that we're talking about a replay of 2008. It's similar processes, and there's a lot of similarities. You have a weak economy that's experiencing a credit problem and central bankers who get fixated on oil prices that are rising for non-economic reasons. They think it's inflationary. Meanwhile, the real problems in the economy is in the banking sector, in this case, the shadow banking sector, which leads to an erosion of economic activity, potential, and eventually employment. So central bankers are worried about oil prices and taking their eye off the ball. In fact, I keep pointing out this is, people don't realize this. And in July of 2008, the ECB hiked rates. They hiked rates, 4 months after Bear Stearns? After Bear Stearns, they hiked rates. And they were going to do it again. And the Fed was going to join them. You'll read some of the discussions by the Federal Reserve, the FOMC in 2008. They were talking about Bear Stearns was the worst of it. Our rates are too low. They're going to contribute to inflation. Oil prices are already sky high to begin with. 2008, we're going to have to raise rates really quickly. If it wasn't for Lehman Brothers and the rest of the economic crisis, or the rest of the monetary crisis showing up late 2008, the Fed was going to hike rates too. So that's kind of the same scenario here. It's not the same, it's not the same, details. It's not like we have big banks that are going to fail, but it's the same general setup. You've got a weak economy, you've got a credit problem, and you've got oil prices now that come to the forefront. And you've got central bankers who predictably are choosing to focus on oil prices rather than what's important. And so the lesson in 2008, as far as the bond market was concerned, because we saw the same thing happen in 2008, as far as bonds were concerned. After Bear Stearns, the 2-year went from around, 130, I want to say? It was really low. And it got all the way up to 3% in a matter of a couple of months. In one part, in June of 2008, this is the exact parallel. I think it really fits. In June of 2008, Ben Bernanke did a couple of speeches where he said the worst is behind us. And he also said that oil prices were going to be inflationary. So as far as everybody was concerned, and Bernanke basically confirmed it, the rate hikes were done, according to Ben Bernanke and most officials. June of 2008, the two-year treasury yield backed up by 60 basis points in about 6 days. That's how big of a reaction it was in the marketplace, and for the same exact reasons. The market wasn't saying things were fine or that oil was going to be inflationary. What they didn't know was how far central bankers would be able to go in the short run, contrary to reality. And of course, the Europeans proved it in July by actually hiking rates. But eventually, the markets all turned around and rates went down very quickly, which, we got to hope is not the same parallel, because we don't want central bankers cutting rates quickly because of what that actually represents.
Right.
Let's talk about shadow banks, Jeff, for a moment. Do you think that exposure is large enough to create a black swan event, or is it just going to be a slow grind down?
Joe, you got to stop using the black swan analogy, because they're never black swans. They're always gray swans.
Yeah, it's a great book, by the way.
Yeah. If you don't know the difference, a black swan is something that's supposed to be totally out of the blue, whereas a gray swan it's been sitting there the entire time. We can all see it. We just choose to ignore it until we can no longer ignore it. And that's, right. I think that's a far better analogy. You guys remember in the 2008 crisis, before 2008, everybody knew this was going to be a problem. We could see that the housing market was in a bubble and it's going to create massive problems. It was not a black swan by any means. It was Everybody just ignored it until they could no longer ignore it. So the same thing with private credit. Private credit built up over years and years and years of everybody thinking, if the economy is not strong, it's going to be next year. Oh, okay, it's not this year. Okay, it's going to be next year. Okay, it's going to be next year, right?
Yeah.
So as Gunlack said, or everybody, Jamie Dimon's quip about, people doing dumb things. We all knew it was taking place. We all knew that there was no underwriting. They all knew that it was bad loans. It's just a question of how big and how much. So Joe, to your question, nobody has any real insight into how big the problem is. I put some numbers together using some rough statistics. To me, the overall upper limit of the amount of credit that could be potentially involved and classified as garbage lending is like $4.5 trillion. Not all of that. The vast majority of that is perfectly fine, and that's true of any crisis, by the way.
Right.
Crises are usually the vast majority of assets are fine. It's just the margin at the top or the margin at the bottom, however you want to characterize it, that ends up being bad. So it's sufficient. 4.5 trillion is not 2008, but it's big enough that it could lead to a systemic snapback that creates macroeconomic problems at the very least, and if not, financial volatility on top of it.
Right. And I think as well, we don't know how much bezel is out there, right? Like, I think, we're seeing with MFS, the double pledging, and I know that there's one here. I'm on the hunt for it, that's doing this. But it's so shocking, right? Because I was on the other side of an article very similar to the one that Chase wrote, where they wrote down those loans, the loans on their private credit loans. And I wrote about what that then entails, having been someone on the other side of that, my former company. When they're going to write down your loans, it triggers a whole series of events that turn into a liquidity scramble through distressed asset sales. I retweeted your tweet because that's exactly how it works. And so there are people out there right now freaking out, worried about tangible net worth covenants and scrambling because of just that news article. But I think it's pretty gnarly. And I think we don't know how bad it really is, because I was just speaking with another reporter. There is just so much fraud out there, because in my view, I went from, okay, we fixed everything in mortgage. We did all this, we trained people, we did all this. So I went from thinking that everything was okay. And then in servicing is where you always see it. And I oversaw servicing for some clients and was like, oh my word, we didn't really change anything. We just got really much better at it, actually.
No, it's Wall Street always invents new ways to be stupid.
Right.
we got the last one cleaned up. Let's go do something different. Oh, yeah. that one blew up. Oh, we cleaned that one up. Let's go do something stupid over here. You know what? I keep saying that human nature is undefeated, because that's what it really is. I mean, every bubble in history follows the same general outline, because it's us, it's people. Mm-hmm. Right. It's not anything systemic. It's not, new technology. It's really just the underlying dynamics of human nature. That's really all it is. And you're right, though. It's not losses that actually produce the bigger problem. It's what you just said. It's information asymmetry that leads to a loss of trust. Right. So what we're really trying to look for, and I just did a long webinar on this yesterday, what we're really trying to look for is behavioral changes that tell us that something has changed as far as the overall condition of the financial system. And we're getting confirmation of that from all over the place. And it's not about losses. It's about the fact that we all know there are going to be losses, but we have no information on how big they're going to be or who's going to end up taking them. And what that does is it erodes trust. And as trust erodes, and as you said, Melody, double posting of collateral, it'll erode trust far faster than anything else, because collateral is supposed to be the bedrock of safety, trust, and faith in the system. When you've got this much widespread fraud, whether it's just double posting or collateral doesn't exist, doesn't matter. Nothing will erode trust faster than that. And once trust erodes far enough, it impairs functioning in markets. So it's not really an issue about money supply. Will the Fed create balance sheet space? It's really about functioning in the markets that has to do with faith, trust, and lack of information. So that's where this that's kind of Wall Street's genius on the upside, is to create all these new forms of credit, but doing so out of the prying eyes of the public and the investment public too, which on the way up makes some sense. There's some legitimate reasons for it, but on the way down, it creates this pro-cyclicality that contributes more to the negatives than not. So really, it's not about the losses. It's about the functioning of the system, which is really about sentiment.
And we know that private credit, one of the reasons commercial real estate did okay last year was because private credit went in there lending. And to your point about it not being transparent, I will go look up specific securitizations, and it is almost impossible to really find out who lost, because of the credit risk transfer, securitizations, et cetera. So it is a web that hardly anyone understands,
That's why, not sorry to interrupt, but I'm saying that's why, these bankers, there was just a conference at Morgan Stanley that all these top bankers said, oh, we have no exposure to private credit. I'm thinking, bull, you don't, because you have exposure somewhere. You maybe don't have direct exposure. So maybe they're being all lawyerly and saying, well, we don't have direct exposure. Sure, you don't. but you've got some exposure somewhere, because you're right. It's a tangled web of all sorts of interconnecting liabilities, and then assets, and then it's, interests that are sold here.
Yeah, exactly. And all these vehicles, and it is impossible. They don't probably even know,
No clue.
And can't find out. That's the crazy thing. Like, it's just, you look through this stuff and you really can't glean any information. And I've really come to the conclusion, like, that, it is part of the design that people can't figure out where the buck stops. And you're seeing on the household balance sheet side, like in the Fannie Mae books, debt to income is already at 2008 levels. Like, that is insane. I had to, again, reteach myself what happened and what happened after, because we promised that would never happen again. Promised. And now, it went bananas with lending. And so we're gonna, and all kinds of non-traditional products that are not reporting to credit, when buy now, pay later wasn't reporting to credit, a lot of them. But I've also found, Jeff, and you may know this, the agencies, Fannie and Freddie and FHA, they do non-performing loan sales. And when they sell those off, they go to hedge funds who oftentimes use a servicer that doesn't report to credit. And so our delinquency, our idea of what actual delinquency is out there is wrong. As well as Fannie and Freddie didn't record their payment deferrals, which was the workout to the forbearance. And so you've got junior liens out there that aren't recorded on public record. 1.8 million people when they last reported, and they stopped reporting. So, like, we're completely in the dark from what's really going on out there. And it seems as if by design.
Well, part of it's by design for sure. And I know, Joe, when you were talking about this earlier, a month ago, you brought up some of the stats on it from our Eurodollar USD Live event. It's the same thing in private credit too, where you have all these different ways to basically obscure what the real state of the credit portfolios are, which is, on the one hand, you buy the argument from Wall Street itself that says, look, some of these are longer run assets. Sometimes they need time to cure, but let's be honest here. We know that's not the case. Instead, PIK and selective defaults are nothing more than tactics for these fund managers to say their portfolios are performing. And it's really just another sort of extend and pretend sort of technique. Yeah. I didn't realize how widespread it was in the mortgage space. I've been mostly focusing on private credit, and you guys know that better than I do. So when you're talking about some of those things, I'm like, it isn't just one place or another. What really happened here? Everybody just went crazy. And I think that's what's really at root here is 2020 and 2021. Mm-hmm. For a lot of people, especially in the financial services industry and some other industries too, they sort of took it as a reset. The 2010s were what the 2010s were. We had the pandemic, the lockdowns, but more importantly to them, you had the government come in shoveling money at everything, and supposedly that reset everything. And so the 2010s were all, okay, we can put that into the past and we're moving forward here. And there was this attitude that the 2020s were going to be completely different than the 2010s. Yep. And it's kind of like they're right. It's turning out to be the 2000s, not the 2010s.
Exactly. Joe, you mentioned the SNL crisis, and this is something I'm trying to understand more, because we're seeing all the seller financing and things like that we saw back then due to higher rates. Tell us, do you want to share some thoughts about that?
Yeah, sure, Melody. I was a young man during the SNL crisis, but I saw a lot of parallels to what's been going on now versus then. And commercial first collapsed, then residential, and that's some parallels in it. And I think that had to do a lot with the inverted rate curve. It was so long in terms of the length of time and the consequences from that. But it was a slow grind. It was a slow grind over many years. Even though we had the SNL crisis, there wasn't as much, I think, leverage that we're seeing today, and some of the other things that's obscure that aren't out there. But so far, at least, it's been more like that time. You mentioned the gray swan earlier. So who is Lehman Brothers this time? I guess since it's the gray swan, can that be identified?
Yeah,
that's the question. I don't know, or do we need one? That's the other question. Or is this going to be a long slog? I can see from a boots on the ground perspective. I'm seeing in many zip codes throughout the country, with average incomes and average mortgage payments, debt ratios for the housing part, 40 to 70% of their gross income. Now, how's that sustainable?
And we know it's not.
I don't get it.
Absolutely no, it's not.
Yeah.
Everybody in the industry that lends knows it's not. And it's like, I think we just got a whole bunch of people lending that didn't know what they were doing. And I've talked to some of these private credit folks, and they were primarily relying on credit scores. And it's like, but those credit scores were inflated. So what were you thinking? It's very hard for someone who kind of grew up in credit to watch what's happening, because I was like, no prudent lender would participate in this kind of stuff. But they've gone crazy doing all kinds of there's a company called Notable where you can just get a loan to spruce up your home to sell it. I mean, there's all these little companies doing that kind of lending. And so, yeah, who is it going to be, Joe? I think, what is it, Cliffwater? That story is just beginning, in my opinion. And then Blue Owl is, you go through their list of investments and you can't stop laughing. Like, it's like,
but are they large enough to have that kind of a material effect to the economy?
Well, I just
not the same way as like a Lehman Brothers or regulated bank. It's that's why it's not an exact parallel to 2008, because 2008 you had money dealers and banks themselves that were involved in it, which is a whole different ball of wax. But what you're saying, Melody, is just you look at some of these firms and you think it's, again, human nature, right? When you get into these bubble periods, people like to rationalize. And so what we have invented are these various different ways to allow people to fool themselves. And you just mentioned credit scores. Yeah. People knew credit scores were inflated, but when you're in that situation where everybody's making money, everything seems to be okay. You get the recency bias. I've got a mathematical number in front of me that says I'm okay, even though I know it's crap. I can put it in the file and nobody's going to come back and criticize me. I'm going to get my bonus. It's volume, volume, volume. You just get into this bubble type of behavior where you lose sight of common sense and basic underwriting. This is where management's supposed to step in, right? This is where managers are supposed to say, hey, guys, we're doing something wrong here. But that's, management gets easily co-opted in the bubble behavior as well. And everybody loses sight of the big picture, because we're all human and this is just kind of what happens. So now the question is, what's the cleanup going to look like?
Right.
That's
right.
And I happen to think, and I think Melody, just listening to your comments here, I think you agree with me. We don't really know, because we're still very early in the process of discovery, let alone trying to put together what that means moving forward. We don't have anywhere close to enough information. And you can't get any information. We just talked about it. It's just not available. In fact, the only way you can get any information is when one of these things blows up. Right. And then hopefully eventually you hope some of the documents show up in a court docket someplace and you can get a look at them. But even then, like Tricolor last year, there was basically a partial disclosure rather than any kind of full disclosure. We still don't really know what was going on with Tricolor. We have some idea, but not really the full level of details and full scale of it. And you don't have any idea how many other Tricolors are out there, still sitting there, probably on some kind of bank revolving credit, with the idea that, hey, JP Morgan's going to fund me for the next 6 months because everything will turn around before the 6-month period is up. Which, by the way, that brings me up a really important point. When JP Morgan revalued the collateral, what was that, last week or the week before? To me, that was like, this is big time, because what they were really doing is saying, we've got all these revolving credit lines that pre-existing with some of these shadow banks. And of course they're collateralized, right? So you have a revolving credit line as a, investment fund, sort of like a break glass in case of emergency, use the revolving credit. It's pre-existing. It's already set up. JP Morgan is not happy about having that credit line. They gave it to you years ago. They can see where the situation is, but because it's collateralized, JP Morgan is using collateral as a way to get out of all those revolving credits. That's right. Which is big deal if you're a shadow banker who is facing hedge fund and investor withdrawals. You've got liquidity pressure, and JP Morgan just tightens the screws on you and says, you can't access that credit line that you thought you were. It puts you in a much different category. And so the question is, JP Morgan going to be the only one who does this? Or are there other banks that are going to start revaluing collateral and rewriting their collateral rules that then starts to really cut off the shadow bankers from their emergency liquidity, which is where the feces really hits the fan blades?
And I think that's exactly what's going to happen. They're going to be first, and then people will follow. And, And it's ultimately the same. I was like you, Jeff. I was like, well, here we go. This is it. It wasn't any of the gating of the funds or anything. It was Chase. And I was like, okay, here we go. Put on your seatbelt, because it immediately starts the liquidity scramble, because you realize suddenly you have to sell those assets. You're going to have to pledge more. And at the same time, you're selling like assets are getting written down. And so, kind of your asset base just quickly erodes, and you're out of cash fast. And so, yeah, to your point, Joe, yeah, not a systemic, but I have a feeling these tentacles are everywhere. And, it is going to be a process of discovery. How long it takes, who knows? But I saw too, when Chase said that, I was like, okay, next are the rating agencies, right? Because they never act until it's too late. And I think the few days later is when they downgraded, was it Cliffwater? I can't remember who they downgraded, but that's it's all a sequence of events here that once permission has been given to see the gray swan that's been standing over there the whole time.
Once it's okay, right? Once somebody provides you cover to say, oh, look, the gray swan has been there. Everybody says, oh, okay, now we can do it. Yeah, you're right. It was Moody's who downgraded FSKKR's fund.
Okay.
What made me laugh about it in the first paragraph, they softened the downgrade by saying, we're not concerned about the fund because they have access to revolving credit lines.
Right. It may be.
Do they? Are you sure that they have exactly? Maybe they do today, but maybe they won't tomorrow.
Right.
But it's not, I think many people frame this the wrong way. A lot of people are looking for what is the next Lehman Brothers, right? I mean, what's the next big event? That's not really what the Lehman Brothers, that came at the end. That wasn't the thing that precipitated the crisis. That was how you knew it got to be that bad. And so you're not really looking for failures per se. What you're looking for is systemic failure, which is completely different. What's like what we're talking about here. It's when everybody beforehand was afraid to do anything other than what everybody else was doing, which is do more and more stupid things, and everybody's making money, so who cares? And then on the downside, it's when everybody starts, as you said, Melody, I love the way you put it. When JP Morgan gives you permission to start looking at the downside and start taking action on it, everybody starts to do it.
Right.
That's just the way financial services is. It's always pro-cyclical. It's always herd mentality. So as JP Morgan cuts off the revolvers and other people cut off the revolvers, some of these shadow bankers are going to be stuck. What are they going to do? They've got liquidity pressure from investors withdrawing funds, which is not going to change because let's face it, these shadow bankers are doing themselves absolutely no favors, because all they keep saying on TV is, we don't know what's wrong. We can't believe this. Our performance is terrific. How could anybody want out of our fund? Right. That's the exact wrong thing to be doing right now. What these shadow bankers should be doing is, we screwed up. We're sorry. We did a bunch of stupid things. We did lend to people we shouldn't have lent to. We're probably going to have to take a little bit of a loss. We're very sorry about that, but it's kind of manageable. It's not that really a big deal. That would be far more believable than saying there's absolutely nothing wrong. You're crazy if you start pulling your money out because there's everything, it's completely fine here. And it's only just creating more and more mistrust. And it's also feeding the perception that there is something to be afraid of if you're not even willing to admit that what we can all see is the truth. Right.
Yeah, they're, like you say, they're not doing themselves any service. With all of this, I would love to talk about labor. I obviously followed a lot of your talks about labor. And, what is your read on AI? I have a different read than most, but what is your read on AI and what that could potentially mean for employment?
Oh, I am positive on AI, just not in the short run. I think it's got a long way to go. I think there's way too many technological problems that, of course, AI proponents are glossing over. I think we all know that. I mean, I use AI every day for research. I don't trust it for anything more than that because it tends to hallucinate way too much. But I think people understand where this is going. Where it goes is that AI doesn't replace people and doesn't replace employees. It replaces hours. It makes employees more productive. So what you end up happening is that employees become more productive, which means businesses become more efficient, more productive as well, which leads to long-run economic growth. And I think if it works the way I think it will, if it does create a productivity revolution, probably, 5-10 years into the future, maybe longer, depending on the technological challenges. What ends up happening is we trade productivity for hours. So businesses can get the same out of the same number of employees in, say, working 4 days as they could in 5 days or even 3 days. So rather than having widespread layoffs, yes, some jobs will be eliminated. That's just true of any technological change. But rather than having widespread unemployment, this dystopian future of, everybody's jobless and on universal basic income from the government, what you end up having is people are still employed at roughly the same pace, the same way. They're more productive. So instead of a 5-day work week, we have a 4-day work week, but some people having a 3-day work week because AI is allowed employees to become that much more productive. They don't have to work the same number of hours to produce the same amount of output. And businesses that are smart will realize the future is not just laying off all their employees and turning it over to robots. It is a robot human partnership where the robot makes the human that much better at what they do.
Yeah. And, so I worked in fintech for several years when I left mortgage servicing proper and went to fintech to build mortgage technology. And what I can tell you is there's no will in these corporations to get this done. They may all be talking about it, how great it is and blah, blah, blah. And people may be putting guns to employees' head to get it done. The problem is you just don't have that type of work ethic anymore in corporations. It's like Soviet Russia these days. You can't get anything done. And so I believe in the promise of the technology, but I have worked in corporate for too long to understand that many of these companies will not be successful at launching it. And those that are racing to do it, now you fall down bot hell, and when you call customer service, those companies are not going to sustain, people will stop using their products. And so I think that the hype, like you say, I think there's definite promise in the technology, but it takes a lot of work. And so when I left fintech, basically a lot of the companies that were talking about AI were actually paying people in India to perform tasks and calling it AI. And that's because paying them was less expensive than actually paying
using
for
an AI,
developers and all of that. And so I just think, I did a case study in Salesforce. They just completely messed up with how they did their AI agent. So I think that this is something that's going to take some time, and that what we're seeing right now is more obfuscation of, they overhired and and they're blaming it on AI.
Well, it's the convenient excuse, right? It's our business isn't picking up like we thought it would. We did overhire a couple of years ago. We'll just blame AI and just get rid of a bunch of people. That was the big story from what was it, Dorsey's block. Everybody went crazy. They're bringing AI to the forefront. No, what he said was we need to get rid of a bunch of people so that if we do get a business uptick, we can be prepared for it. It would actually having the right number of employees. What did he say? We hired two companies worth of employees because they had two different businesses, and they had to get rid of one because they combined them together.
I heard.
Jeff, I have a question for you. What do you see though, as far as more near term, as far as the direction of the unemployment rate?
Oh, it's going to continue to rise. It's been rising for the last almost 3 years now. Right,
but will it be? Do you anticipate that what we talked about earlier about the shadow banking potential fiasco that would have an impact on unemployment, or what will be the contributing causes to what we see increase from here? I guess is the question.
It goes in both directions, because in many ways the private credit bust was triggered by unemployment. That's where the weakness at the margin started to create problems for businesses like Tricolor. Tricolor being a subprime lender, don't need to get into the detail, but Tricolor being exposed to mostly subprime businesses started to see much more weakness at their margins, which forced them to do a bunch of shady stuff that actually triggered the entire business being exposed for what it had been. So unemployment is a pressure on private credit, and as private credit as one of the few credit outlets to the economy to begin with, is that starts to really pull back, it's going to force a lot of firms into uncomfortable decisions, which is going to raise unemployment even more, which then pressures private credit. And that's where you get into the macroeconomic, the self-reinforcing spiral. Mm-hmm. So, where the one leads to the other, which leads to back to the first one and back and forth. And some of the worst case scenarios come from that. I'm not saying it'll be catastrophic, but it certainly is going to, we have a bad situation to begin with, and this is not going to help it, nor will the oil shock because higher energy costs just pressure everything that much further. So unemployment, I don't see any way that unemployment doesn't go higher from here. The real question is by how much.
Right.
And the answer to that one is not necessarily comforting either, because when you're already into a regime where you're losing jobs on net, it's really constitute a state change where you have demand for employees that goes down in the initial stages, and it doesn't trigger that much unemployment because businesses tend to absorb the initial hit. But when they no longer have that ability, any additional pressure that comes along leads to almost directly an amplification effect where they just immediately something bad happens, boom, people get laid off. Whereas before it was something bad happens, you might take a little time to digest, maybe take a little bit smaller steps, cutting back a couple hours or something like that. But the danger here is that the labor market state changes to the full blown, we need to get rid of people, regardless of what the reason is. We just can't afford anything else to happen.
Yeah. And it's, and I agree with you about sort of short-term prices going up. Long-term, I see deflation, but short-term, I mean, this is a situation where I think it was Dow Chemical came out and said they're doubling their prices on plastic. I mean, this is, it's when you try to talk to friends and family, they don't really understand what's coming, in terms of shortages and things like that, because, they don't realize that oil isn't everything, or urea is in moisturizers, or what, we don't have a connection to what, goes into all these products that we use every day. And I mean, the price increases will come. They will be rejected, in my opinion, but they're coming,
Fertilizer, that's a big one.
Right.
Food prices are going to go up a lot again, just like 2022.
Yes.
But the thing is, we saw before March, Steve and I were just talking about this, Pepsi, McDonald's, and a whole bunch of, food companies that are saying, we got to cut our prices.
Right.
We've been raising prices for the last couple of years, and we've been sacrificing volume because more and more customers can't afford them. So if that was the situation before March, what happens after March? Right. So as these prices and the costs go higher at the lower ends of the supply chain, and they kind of start to filter their way up, who's going to end up taking that hit? Because even before we got to that, a lot of businesses are saying we have no pricing power. We have no ability to increase our prices or without triggering a significant backlash in transactions and volumes. So where are those costs going to translate? And Melody, I think what you're saying is, and you're correct, is that what it leads to is not inflationary prices. It leads to shortages. It leads to bottlenecks because nobody can effectively respond to increases in cost. I mean, plastic prices that are doubling. A lot of people are just going to say, I can't afford that. So I'm not going to even bother with it. I can't even do anything with it. It does create a sizable hole in the economic structure and supply chain that, again, surprising to most people, leads to higher unemployment, not higher inflation.
Right. Yep. No, I agree. And just kind of turn it over a little bit to real estate. One thing I want to mention to you about the fund tools and how the mortgage industry got smart last time was automated underwriting systems that people learned how to game. I mean, it was very easy to game them. And it was just similar to our earlier conversation where you just got that approval when we were talking about credit scores. You got the approval from the GSEs and you're like, I'm money good. I'm all good. I get my bonus, And so you could see during the COVID boom, it was just insane, Jeff. Like I can't explain how busy everybody was. Like I was working on a project at PNC where we were processing maybe like 5,000 pages a day or something like for refinances. It went to 1 million and almost overnight. And so it was absolute bananas. And so in that situation, you don't even have to have people who are willfully, committing fraud. You just have ineptitude and you just have people just racing to get stuff done and missing all kinds of things because they were I didn't sleep for months because it was so busy. So I look at that and I know what's on the other end of that because, proper due diligence wasn't done. And I mean, that's what all this is proper due diligence was not done.
And you wonder why FHA has the default rates that they have when they have DTIs of 50% of gross income. Seriously. I mean,
But you know what the problem is for a lot of people though is it's they get what you're saying, but it doesn't seem to connect to the real world. Like the stock market.
Right.
Most people's conception of how the financial system is or the economy is Wall Street. It's the stock exchange. So if the stock market is at is at an all-time high or very close to it, it's very easy for people to say, well, okay, I hear what you're saying and it makes sense, but it doesn't seem to matter. It doesn't seem to be a big deal because if it was, then we would see the NASDAQ down a lot more than it is. Yes, NASDAQ's down 10%, but why isn't it down 50%? Because what you're saying sounds really bad. Why isn't the S&P 500 further away from its high?
Right.
And that's part of the recency bias that goes into everything. It's the idea that, okay, this is all esoteric stuff that's in the back room. It has no connection to tangible reality. Therefore, it's very easy to dismiss and ignore.
Right.
And that's why most people think that there is a black swan, because they hear this stuff and it doesn't connect to reality. Then all of a sudden it does, seemingly at once. That's the old, I think one of the lessons about credit cycles and credit risk as a whole is that Wall Street is very good at selling recency bias. What they say is in all the performance numbers, right? The performance numbers during a bubble period are terrific because nothing bad has happened. Therefore, if we extrapolate the same performance forward, nothing bad will ever happen. So they sell you on the recency bias, but what happens in reality is it's a discontinuous process. So for a very long time, it looks like there's absolutely no risk. Meanwhile, the risks are building up in reality, just behind the scenes and under the surface. But it looks like there's absolutely no risk. And then all of a sudden, seemingly out of nowhere, the black swan shows up, which is the moment when everybody realizes all the stuff that we ignored beforehand, actually, it did matter. It had mattered a great deal. We just couldn't see the connection to reality because it was all in the back office stuff like you're talking about, Melody. That is just terrifying. The idea that we're auto-stamping 1 million documents, it's just... That is terrifying.
Yeah.
But you have this idea that if it works day after day after day, week after week after week, and the system just keeps churning out 1 million more and 1 million more and 1 million more, then how can it possibly go wrong? It seems to prove itself. It seems to establish that there is nothing wrong because it seems to function in a way that allows everybody to go about their daily business. It's very difficult to connect the dots to, we can see the problems over here and you will see the problems over here soon enough.
Yeah.
Hey, Jeff, question for you. So historically, when you look at economic cycles going a little bit further back, and you see situations where they're kicking the can down the road, in this case, more than 15 years since 2008, and the amount of bad stuff is building up behind the background, and whatever causes that first domino to drop, it can be much worse than people anticipate compared to a few series of smaller recessions by letting the market work as far as that kind of exposure.
That's always the downside, right? Is you don't want failures and trouble to cluster. And that's what always happens. I mean, that's, you would rather have, whether it be in the macroeconomy or in the credit system itself, you'd always rather take losses intermittently. At least that's what, the rational take on things would be. You want to take your lumps and you want to make sure that they don't become a common occurrence where everybody's doing the same thing at the same time. I'm just not sure that's realistic. I'm not sure that's ever really happened. I think there was probably a time when more people were more willing to take risks. But even you go back a long, long time when I think people romanticized the past a little bit too much. And there's this idea that people in finance took a more realistic take on what they were doing. And I'm not sure that was ever really the case either. There's always this human nature and tendency to just put it off until tomorrow. It's easy to do so, especially when you don't see anything meaningfully impacting your operations today. If you can get away with it, why not try to get away with it? Because you never know. Your future's uncertain, so maybe something will go in your direction. And I think that's really what's been sustaining the idiocy in private credit, and I guess you guys are saying in mortgage credit too, for the last several years, is the idea, okay, we're doing a bunch of bad loans for the few people who might be aware of it, but things are going to pick up. I mean, we keep hearing this from the Fed. Things are going to pick up. It's going to turn around. The stock market keeps hitting new highs. That's got to be good, right?
Right.
So, yeah, maybe I should take some losses, but why would I? If the future is going to be so bright, I'll just put it off another year. we'll deal with the problems when conditions are much more conducive to doing so. I mean, that was the attitude in commercial real estate back in 22 and 23. The idea was, okay, let's extend and pretend until the economy recovers, and then we could take our losses and do so in a relatively benign circumstance. But they're still sitting there. Nobody's taking any losses. That's still sitting there. Historically speaking, that was one of the big problems the Japanese fell into in the 1990s. The idea was that this mistaken idea of what the Great Depression was. The Great Depression, people, okay, we can't have banks fail. If banks fail, that leads to depression. So bank failures equal depression. Therefore, we need to bail out every bank no matter what. We need to bail out every financial lender no matter what, because we can't have a Great Depression. Instead, what they did is they prolonged the agony for long enough. I mean, an entire decade. They didn't start cleaning up the banks until the late 1990s. And by then it was way too late anyway. So instead of a 10-year-long depression like the 1930s, they got a 40-year nightmare because the banking system was completely obliterated by the time they got around to actually cleaning everything up. By then, the banks were nowhere the same capacity they'd been before. So there's really not a whole lot of good options, which is why most people start to talk about, how do you prevent bubbles from happening, which is at this point, it doesn't help us now because we're already there. But that's really why you focus on not having the bubbles happen. And to Joe's point, one of the ways that you would prevent bubbles from happening is to either convince people or force them, which I'm not in favor of either, but do something to make it to incentivize people taking losses relatively regularly rather than saving them up until the same point where everybody takes their losses at the same time.
Yeah, that was my point, Jeff, is because historically, at least when I was a younger man, we would see recessions about every 5 to 7 years, maybe every 10 years, but this one's been longer. And because of that, I just think there's a lot more risk because of this buildup over the 15-year period. And by the way, I don't know how much more time we got, but you want to, there's a commonality here that we're talking about with respect to loss of faith and trust in a lot of the U.S. institutions. And I being a student of history, I had to start thinking about the fourth turning, which actually started in 2008. And where it's leading to and how that ties into what we're talking about. Do you guys see any insights there?
Oh, there's always social and political consequences to periods of depression. The slogan I always use, the cliche, is that when rate of change in economy goes down, rate of change in politics goes not just up, it goes way up. And the longer you go without economic growth, the more extreme the political situation and social situation will become, which it ends up becoming something like the fourth turning. I think there's a lot of insights into that whole. It's more of a narrative. It's a historical recounting that we can actually see play out.
It's a framework. The way I think about it is a framework to some degree. But yeah, I totally, and you can see it. I mean, you really can see it playing out. And like you said, things just start to speed up. And I feel like we're in that time, right? I can't even keep anything straight anymore because it's all happening so quickly. But yeah, I want to talk a little bit about REO and real estate owned, Joe. And I should have let you guys just do a quick intro in the beginning, but I was too excited. But Joe, tell us a little bit about what you do and how you know us.
Well, Melanie, I've been in the real estate business with a heavy concentration on distressed real estate, distressed mortgages over about a 40-year period. For 5 years, I worked for the largest servicer of distressed mortgage debt in the country from 97 to 2002. And I saw a lot of things that were very interesting. I could put it that way. From that, after I left there, when 2007, 2008 came along, a lot of my buddies that were in management positions went on to other subprime lenders. And you talk about getting crazy busy. I went from a one-man operation to 8 people for managing, a few assets to 100 to 150, sometimes 200 assets, literally within 12 to 18 months as far as the growth period.
Right.
We saw values go down, depending on the zip code, at least in South Florida, 50 to 60%, 65%, depending on the zip code. Yeah. And I find some interesting parallels on some conversations that I'm hearing today from people where, that can't happen again because we have so many people that pay cash. Well, if you look at the actual percentage of people that are paying cash for homes, it's about the same as it was last time.
Exactly. Yeah, I agree. Yeah. Mm-hmm. Yeah.
So so we see opportunities that, as far as what we're working on. There's things I can't really talk about on this podcast in terms of promoting what we're doing, but I'll just say there's a great opportunity that I feel is there. Jeff gave me the opportunity to talk a little bit about that at his investor conference.
Mm-hmm.
And it ties into what you've been saying, Melanie, about 9 months ago, saying that this cycle is going to be worse than 2008. And I 100% agree with you.
Yeah.
100%.
Yeah. And
it doesn't matter if a lot of people are paying cash for homes if the people who are borrowing are in worse shape than they were 20 years ago.
Exactly.
Right.
It still ends up bad either way.
Right.
Exactly. Right.
And it's even worse when they're not on a entity's balance sheet, because you get blight very quickly, because the servicers pay property taxes, insurance, pay to do like winterize your home, mow your grass, and when they're not around, all of a sudden you're next door to somebody's grass who's up here, and your property values start to go down. So
those values are kind of reset at the margin as far as once that starts, it kind of starts snowballing. And that's when people kind of lose faith in the asset class. And that's, it's an emotional thing for a lot of people.
Yes.
So that's all part of the psychology of the market, that has to be
that's probably the most interesting part of the discussion, at least from a big picture perspective, is once that thing starts to roll over, there are very few ways to get it to roll back.
Right.
Especially the further downhill you go, the less of a chance that there is a off ramp.
Right.
So when you start to get in a situation like we're talking about with private credit, where JP Morgan is throwing in the towel saying, look, I'm going to start distancing myself from some of our contractual commitments. How do you get them to go back? You can't. It's almost always a one-way street in a one-way direction. So it's no longer about how do we get out of this. It's really about what does it mean in the end? Where does this actually end up? And so it's a complicated. I mean, like I said, we're in the early stages here. We don't have nearly enough information, but it's very clear that there's a big problem here. And what I'm getting from both of you guys is that it's not just, Blackstone and Blue Owl, that there's, FHA. Are you kidding me?
13%.
Now we got to deal with that too.
Yeah. Government subprime, Jeff. Government subprime. And that's what I was going to say to your earlier point. It's like, we just let the markets correct, but no, the government gets in and they do all of this massive manipulation, which never even ends up helping the homeowners, because they just live stressed out when they're underneath these forbearances, loan modifications, and most of them can't. Jeff, they don't even underwrite the loan modifications anymore. They used to. They used, like back during the GFC, we had to fully re-underwrite when we did a loan modification to see if they could actually repay. They just send them in the mail now.
But then it just kind of sits there, right? It's just another way of just extending it down the road a little bit longer while the letters go unanswered and they stack up in the mailbox or in the kitchen counter or whatever. It's just
it's so frustrating.
Melanie, you mentioned the COVID forbearance. I've saw some numbers where at least what I've been reading is up to 7.8 million households.
I was talking about the payment deferrals, which was how you worked out of the forbearance. So you had these 18 months of payments you had to do something with. And so they were reporting on this religiously, then they just stopped. So I don't know how many there were, but last report 1.8, I would think it's the majority of people that were on forbearance. So on the FHA side, they did what's called a partial claim. Those actually did get recorded, but the biggest book did not. So it is. So Jeff, it's on the surface, you hear the credit quality gospel singing, which is what I like to say, but mortgage is in a lot more trouble than, even I could have anticipated. And you always see it in servicing. You always see it there. And I'm seeing crazy stuff. But so this is so much fun, guys. So exciting. I want to just end, if you guys could tell the audience where they can find you.
Go ahead, Jeff.
You say, find me at Eurodollar University, YouTube, internet, whatever. Just search for Eurodollar University. We talk about monetary system, monetary economics, basic economics. how to read financial signals because nobody else wants to do it in a proper manner. Just filling in all the gaps that have been left behind by decades and decades of mainstream economics looking the other way, and Wall Street inventing all sorts of ways to do more and more stupid things that only come out when you're actually looking at the right signals, as you always do with the good folks I'm sitting here with Melody and Joe.
Thank you.
Yeah, I can be found by my name, Joe Batag, on X, LinkedIn, Substack, also with our company, Benjamin Capital Group. So you can find us there.
Awesome. Thank you guys so much. This was so fun. And Jeff, I mean it when I say I link $1 in every single YouTube that I do. So, because I think it's a critical foundation, and education that I think so many people are missing, and they get it so wrong. And honestly, I felt like I was on an island all the time saying subprime did not cause, until I found you guys. And I was like, oh, thank God, and I could put together sort of the more like how it actually worked, of all these things that you're talking about. And I saw the banks, pull back from lending due to Basel III, like all of that I lived. And so it was really fun to get to connect today. So thank you both so much. And thank you, everybody. We'll see you again next time.